$29,312, that's the down payment to buy a $550,000 home. And the buyer already has a VA loan on another house. They're not selling it, they're keeping it as a rental. Most veterans think you only get one VA loan, one time, then it's gone. That's wrong. If you already used your VA loan, you can get a second one at the same time. It's called secondary entitlement, and almost nobody talks about it. Most people will tell you a second VA loan needs 25% down. On this house, that's $137,500. The real number is $29,312. I'll show you how the VA figures what you've already used, why your buying power is bigger today than the day you closed, and the 3 myths that keep veterans from using a benefit they earned. I'm Matt Jolivet, president and owner of Associated Mortgage Brokers. I served in the Marine Corps and have over 26 years in this business. I'm a mortgage broker licensed in Oregon, Washington, and Idaho. Entitlement isn't your loan limit. It's the VA's promise to your lender. The VA backs a quarter of your loan. If you ever stop paying, they cover the lender for that 25%. That promise is the whole reason you can buy with no down payment. And it's why you do not have monthly mortgage insurance. Here's where people get tripped up. Pull your certificate of eligibility and you'll see a number. $36,000. Almost everyone thinks that's their cap. It's not. That $36,000 is your basic entitlement. It only covers loans up to $144,000. Look, nobody's buying a house in Portland for $144,000. So you tap the next layer. The VA calls it bonus entitlement. You'll also hear second tier or secondary entitlement. They all mean the same thing. That layer is tied to the loan limit in your county. For 2026, that limit is $832,750. It's the same number in every Oregon county. Same in Clark County, Washington, where Vancouver sits. Same in Ada County, Idaho, around Boise. Take that limit and multiply it by a quarter. $832,750 times 25% is $208,187. That's your full entitlement. That's the total promise the VA puts behind you. So how does the VA know what you've already used? It's simpler than you'd think. They take 25% of your original loan amount, not your current balance, the amount you borrowed on day one. Let's run a real example. Say you bought a home back in 2020 with a $400,000 VA loan. A quarter of $400,000 is $100,000. So the VA charged $100,000 of your entitlement to that house. You'll see it on your COE under entitlement charged. Here's the part that catches people. That $100,000 is frozen. It doesn't drop as you pay the loan down. Paying your balance down doesn't give it back. The only way to free it is to sell the home and pay off the loan, or use a one-time restoration. But you want to keep this house as a rental, so that $100,000 stays put. Now watch what happens. Your used amount is frozen, but the county limit keeps climbing every year. Back in 2020, the limit was $510,400. A quarter of that was your whole pool, $127,600. Subtract the $100,000 you used. You had $27,600 left. In 2020, that leftover couldn't buy you much of anything. Now, jump to today, the limit climbed to $832,750. Your pool is now $208,187. Subtract that same frozen $100,000. You've got $108,187 in entitlement left. You did nothing. You just waited. Now here's how that turns into buying power. Again, the VA backs a quarter of your loan. So your leftover entitlement covers 4 times itself. $108,187 in entitlement multiplied by 4. You can buy a $432,750 home with 0 down on a second VA loan, while you keep the first house. Back in 2020, that number was $110,400. Today, it's $432,750. Same veteran, same loan, their 0 down buying power grew by over $320,000, and they didn't lift a finger to get it. Myth 1, you only get one VA loan. This one's everywhere, and it's just not true. You can have 2 VA loans at the same time. The catch is simple. A VA loan has to be for the home you actually live in, your primary residence. So the home you're buying now becomes your main home. You move in usually within 60 days. The house you already own, that becomes a rental. You don't have to sell it. You don't have to refinance it. You just move out and rent it to someone else. Maybe you got new orders or a new job across town. Or maybe you just want to keep that first house as an investment and let the tenant cover the payment. The VA's fine with all of it. What they care about is that your new loan is for the home you're actually going to live in. Quick pause. Before you ever write an offer on a second home, do one thing. Pull your Certificate of Eligibility, your COE. It tells you exactly what you've used and what's left. If you want, I can pull it with you and run your real numbers. I work with buyers in Portland, Vancouver, and Boise every week. There's a link in the description to grab 15 minutes on my calendar. No pressure, just real numbers for your situation. Okay, let's get back to it. Myth 2. A second VA loan means a giant down payment. People hear, I already used my benefit and assume they're stuck putting at least 25% down. Let's kill that with real math. Remember your leftover entitlement from earlier, $108,187? The VA still backs a quarter of your new loan with it. So with zero down, you can buy up to $432,750. On a second home, nothing out of pocket for the down payment. That's real 100% financing on house number 2. Now let's say you want more house than that. You're buying at, say, $550,000. Here's the myth's version. 25% down. That's $137,500. Here's the real version. The VA needs a quarter of the loan covered. That's $137,500 in coverage. Your entitlement already covers $108,187 of it. You only fill the gap. $137,500 minus $108,187 is $29,312. So your down payment is $29,312, not $137,500. You finance the rest and keep your first house. Now, there's one more cost to know about. The VA funding fee. It's a one-time fee that takes the place of monthly mortgage insurance. And here's where your situation matters. If you get VA disability compensation, you're likely exempt. Your funding fee is zero. If you're not exempt, the fee depends on your down payment. Put less than 5% down on a second use, and it's 3.3%. Put 5% or more down, and it drops to 1.5%. In our $550,000 example, that down payment is already just slightly over 5%. So the fee lands at 1.5%. On this loan, that's about $7,810. You can roll it into the loan or pay it at closing. Now here's why veterans come out ahead. 2 reasons: no mortgage insurance and a lower rate. On a conventional loan with that same down payment, you'd pay mortgage insurance every month. In this example, that's about $304 a month. On a VA loan, you pay none, and VA rates usually run lower than conventional. As of this recording, a conventional buyer with a 720 to 739 score is looking at no points, 6.75%. The VA rate today is 5.99%. Let me show you what that does to the payment. Same loan, $520,687. Conventional, your payment is $3,377 a month plus $304 a month in mortgage insurance. That's $3,681 a month, not including taxes and insurance. VA, your payment is $3,118 a month. No mortgage insurance. That's $562 a month less every month. And that mortgage insurance isn't quick to go away. On the conventional loan, it sticks around about 11 years before it falls off. That's roughly $41,600 in mortgage insurance over that stretch. The VA buyer pays none of it. Even with the funding fee, the VA loan pays for itself in about 14 months. I'll be straight with you on one thing. Conventional mortgage insurance does eventually cancel once you build enough equity. And these numbers assume you keep the loan the whole time. But the rate gap doesn't cancel. It stays until you refinance or sell. Myth 3, if you keep your first home, you can't use your VA loan again. This is the one that costs people the most. They think the only way to reuse the benefit is to sell. So they sell the house they could have kept as a rental. You don't have to. That leftover entitlement we calculated is exactly what it's for. It lets you buy again while the first loan is still open. Now, one honest point. Keeping the house means your $100,000 stays charged. You're using what's left, not the full benefit. If you'd rather get your full entitlement back, you can. Sell the home, pay off the loan, and it's restored. There's also a one-time restoration if you've paid the loan off but keep the house. So you've got choices. Keep it and use what's left. Or sell it and start fresh with the full benefit. Which one's right depends on your numbers and what you want that first house to do for you. Here's what I want you to take from this. You earned this benefit. You put on the uniform, and the VA loan is part of what came with it. And it doesn't run out after one house. A lot of veterans leave this on the table because nobody ever told them it was there. Don't be one of them. If you've got a VA loan now and you're thinking about your next move, find out where you actually stand. I'm licensed in Oregon, Washington, and Idaho. Whether you're in Portland, Vancouver, or Boise, I can run your numbers with you. The link's in the description, 15 minutes, and you'll have real numbers. If this helped, hit subscribe. I break down this stuff for buyers and veterans across the Northwest every week. So, I'll see you on the next one.